Assalamu alaikum. Welcome to video 30. This is IFRS 9 financial instruments, which is there in both SBR and FR syllabus. And most of the trickiest area is IFRS 9, which students often find difficult. So therefore, this revision is going to be a great help for those students who find IFRS 9 difficult. Why it's difficult? Because it's too much technical. There are too many technical stuff and too many things to remember. Okay, but what if I say that you don't have to memorize anything at all, and still you will find financial instruments one of the easiest standard? How? You have to watch this video till the end to get your answers. So I'm going to make financial instruments the easiest subject for you. Okay, now first, financial asset. So financial instruments, you have to understand there are three separate categories. One is financial asset, two is financial liability, three is equity. Let us first focus on financial asset. Okay. Now, what is financial asset? Anything in terms of, you can say, monetary. They are monetary assets. Anything to do with cash. Okay. Financial asset is an asset which gives you a right to receive cash. Anything which is giving a right to receive cash is your financial asset. Anything which is giving an obligation that you have to pay the cash is your financial liability. Okay. Why financial liability? Because assets could be various type of assets like non-current assets, inventory, intangible assets. These were also your assets that we have gone through. But there you did not have the right to receive cash, that you have to receive a cash. Nor other kind of liabilities like trade payables, provisions, leases, they were also liabilities. But it is not compulsory that you have to, there was not an obligation for you to pay the cash. Therefore, they were not financial assets or liability. Okay. So there were other assets and liabilities which we have categorized into other standards. But all the financial assets, all the financial liabilities, they are grouped together and they are dealt under IFRS 9, known as financial assets and financial liability. Okay. Now, financial assets could be of two types. Either you are investing in an equity or you are investing in a debt. Debt instruments means you are having that debt instrument, you are giving a debt to someone. It's like you are giving a loan to someone. So that loan is a loan for the person who is taking the loan. But for you, it's a financial asset because you're going to receive amount. You are going to receive the principal amount, the amount of the loan, as well as the interest from the person to whom you have lent it. So for you, that loan, that investment in debt is a financial asset. Same goes for equity. If you're having shares in a company, you are going to receive dividend from it. So that dividend is a financial asset. That's why that investment in equity is a financial asset. Okay. That's why it's very important for you to understand the various categories that financial instruments can fall into, because each category are dealt separately. Once you understand the categorization, things becomes very easy. Why students find IFRS 9 difficult? Because when you start studying from day one, you start memorizing the terms, definitions, memorizing the entries, that if this happens, this is debit, this is where it goes. It makes it very difficult, trust me. Okay. Understand the logic, understand the whole process. Then you will understand the recording is also very easy. Okay. Now, so first let us finish investment in equity, because this is easy. Less things to deal with. Investment in debt is a bigger part. There we have so many categories. So first let us finish with investment in equity. And first finish from the financial asset side. Do not study two things together. Once you are pro in one area, then study the other area. It makes it very easy. So do not jumble up with financial asset, financial liability, and equity. That equity and this investment in equity, which we are talking about, financial asset, is different. Okay. So investment in equity. Now, investment in equity instruments. Example, investing in ordinary shares of another entity is your financial asset. Okay. Normally, we measure them at fair value through profit and loss. Okay. See, there are three ways. Before I start the lecture, let me tell you, there are three ways you can measure in IFRS 9 all the financial instruments. One is amortized cost, one is fair value through profit and loss, one is fair value through OCI. Okay. But what goes to each of this, that you need to understand. Okay. Like how we measure any asset, we have a cost model, fair value model. Here also we have a cost model, fair value model. That cost model is the amortized cost, and the fair value model is further divided into two, one in OCI, one in profit and loss. Okay. Now, so this investment in equity instruments, if you are having, will be measured at fair value through profit and loss. It's like how you put a value for any asset. Same for this also. Fair value through profit and loss. Why through profit and loss? Because any changes in the fair value, will be recorded in profit and loss. That's why we say fair value through profit or loss. Okay. So it is possible to designate an equity instrument as fair value through OCI following the following provided following conditions are complied with. What does it mean? Yes, we say that it is fair value through profit and loss, but there is an option for you. You can elect the fair value to go through other comprehensive income. This is only for investment in equity we are talking about. But to again do that election, you have to meet the following condition. Without those conditions, if you are not meeting those conditions, it will always be in profit and loss. You can't take it to OCI. Okay. So your equity instrument should not be held for trading, and it is an irrevocable choice for this designation upon initial recognition of the asset. That means once you make this choice, you can't go back. You can't change from one place to another. If you are making the election to be in OCI, it will be forever in OCI. This is only for investment in equity I'm talking about. Why am I emphasizing this point so much here? Because when I go to investment in debt, situation changes, rule changes, then it's very confusing. Students often confuse these two things. Ma'am, you told that it will never be in profit and loss. Why did it come to profit and loss again? Because that is a debt instrument. This is equity instrument. Please understand what it is, what type of financial asset it is. Like non-current asset, we have various type of non-current asset. Property, plant, and equipment is one. Land is one. Then investment property is one. Then intangible asset is one. Same for financial asset also. We have various types. One in investment in equity, investment in debt. Okay. So they will not ask you what are the investment in debt, what are the categories, what are investment in equity category. That they will not ask. Generally, the measurement rule they have told. So in short, investment in equity is fair value through profit and loss. But you can make an election to go into OCI if these two conditions are met. One condition is it is an irrevocable choice. Forever it will remain once you make the election. Then your equity must not be held for trading. If your equity is held for trading, you cannot put to OCI. Think it like that. If you see normally, any profit and loss that is held for trading will go to profit and loss. Same for this also. If it is held for trading, you cannot take it to OCI. What do we take in OCI normally? Recall IS 16. Revaluation asset. When we revalue, that revaluation is not a realized gain. Not that we have disposed and that we have got a gain. It is just on the paper. That gain is just on the paper we are showing. Revaluation gain. So where do we record it? Under other comprehensive income. Mostly your unrealized gain is what we record in other comprehensive income. Something that we have got in cash. We have got the benefit. Realized gain we record it in profit and loss. Most of the item goes in profit and loss only. And anything held for trading goes in OCI. But revaluation is something that we do not normally do for trading. That's why it was recorded in other comprehensive income in IS 16. Okay, think like that. So that's why equity instrument, if it is held for trading, it will be profit and loss only. Then you can't make the election. But if it's not held for trading, then you can make an election that uh, for the fair value to go through other comprehensive income. That's it. Now, that's all about equity investment. Finish. Now, coming to investment in debt. Okay, this is an area which is highly asked. Okay, compared to equity instruments, it is investment in debt which they often test. Why am I emphasizing this? Because whenever the students think debt, they always think themselves from the person of they are the one who is taking the debt. So how is a financial asset? No, no, no. It is you who is giving that debt to someone else. For you is a financial asset. For the person who is taking that debt from you is a financial liability. You understand? Remember, for one party it is financial asset, for another party it has to be a financial liability. Okay, that's how it goes. Normal also. If for you it's an asset, for the other party it's a liability. That's how it works. Now, IFRS 9 requires financial assets that are debt instruments can be measured in three ways. These are the three ways that I've talked about. Amortized, fair value through other comprehensive income, and fair value through profit and loss. But remember, amortized cost is not there for investment in equity. It is only for debt. Equity can only be taken fair value through profit and loss or OCI. Only that. But when it comes to debt, there are three options. Amortized cost. Investment in debt instrument is measured at amortized cost. Please understand it this way. How do you record property, plant, and equipment under IS 16? Initially at cost. Same. Just this is amortized cost. Why amortized? See, financial asset is also kind of an intangible asset. something which you can't touch, and we amortize intangible asset, right? So from there this word came, amortized cost. Okay, because you are going to amortize it at the end. The value is going to go down of the debt instruments if you're holding it for a long period. That's why amortized cost. Of course, you don't have to go behind the details and all these things I'm telling you in a way of a story so that it becomes very easy. So you don't have to memorize amortized cost, that there's this. Okay. So now investment in debt instrument is measured at amortized cost if there are conditions for this also. It is not your choice. Even if they are giving you a choice, you have to meet the condition. If you are in the condition only, you can go by that measurement. Financial asset is held within a business model whose aim is to collect contractual cash flow. Okay. Of course, you are holding that debt not to finance something. It is there for you to collect the cash flow. And this cash flows has to be of two things only: interest and your principal amount of the loan. Could be bond, loan, anything. Okay. It has to be on a specified date, and payment should solely be of principal and interest. Any other payment beyond this, you can't use amortized cost. Okay. So these two things remember. This is like a deciding factor. Are you meeting this condition? If you are meeting both, amortized cost. If not, then we have to see another way. Another way is fair value through other comprehensive income. See, in equity, just now we went through investment in equity for financial asset. Our immediate is fair value through profit and loss. But when it comes to debt, the choice is between amortized cost and fair value through other comprehensive income. We go to P&L as the last resort. That is the end choice. Okay. Here also, we have to meet the condition. Here, you have to hold the financial asset. Okay. So your objective is to collect cash flow. But one more additional thing is here. You have to sell the financial asset. So you are holding the cash flow. That means you're holding that debt, but not for the entire life of the debt. Maybe before that you are selling the asset. So because before that you are selling the asset, you can't use the amortized cost because you're not holding it forever. So when you are selling it, think it like that. When you sell, you always refer the fair value, no? You don't go by the cost, historical cost. So you can't use amortized cost. We go by the fair value. But that fair value comes in other comprehensive income. Okay? Because that is also not something that we normally do in our trading activity. It is only because when we are selling, there is a change in the fair value. That's why we have recognized in other comprehensive income. Okay? And here also payment has to be principal and interest only. But the only difference is the business model. Always check the business model in the exam. Are you holding it till maturity, or you are holding it and then selling it? If you are holding it till maturity, normal cost, amortized cost. If you are holding and then selling later on, fair value through other comprehensive income. Now, the third way. Once you understood those two ways, this is very easy. Any investment that is not measured at amortized also, not measured through OCI also, will go in your fair value through profit and loss. Simple. Now, financial asset part is over. Coming to financial liability. Financial liability, if it's held for trading, they are measured at fair value through profit and loss. Anything held for trading, fair value through profit and loss. Just understand this. Okay. So most financial liabilities are measured at amortized costs. Okay. Now, IS 9 allows the measurement of financial liability at fair value rather than amortized cost, if doing so will eliminate or reduce an accounting mismatch. For example, the change in the fair value of the financial liability is due to a change in the credit risk. This will be recorded in other comprehensive income, correct? So because you are recording it in other comprehensive income, then the balance of any change in the fair value is recorded in profit and loss. So rather than going for amortized cost, you are recording it in profit and loss. You understand? Since you are recording the change in the fair value of the credit risk in other comprehensive income, any change in the balance of the fair value, that means not due to credit risk, you will record it profit and loss rather than at amortized cost. So you are changing from amortized to fair value. This is one example why you want to change. This only you will change when you want to reduce an accounting mismatch. See, for example, one thing, you are measuring in OCI, and on the other side you are measuring it at amortized cost. It's an accounting mismatch. So bring it in profit and loss. Okay. Now, so that's it for financial liability. We only have amortized and fair value through profit and loss. We do not have fair value through OCI. Now, impairment of financial assets. Like any asset, intangible, tangible, it gets impaired. Same financial asset also will get impaired. But impairment for financial liability we do not study. It's only for financial asset, okay? And by the way, impairment was covered under IS 36, but that is impairment for other assets. But since impairment of financial assets separately it is covered in IFRS 9, so whenever financial asset gets impaired, we are not going to follow the rule of IS 36. We are going to follow the rule of IFRS 9. Okay. But before that, you have to go through some definition, some keywords. First is credit loss. Credit loss means if there is any difference between the contractual cash flow and the cash flow that entity expects to receive. That means if they are receiving less than what they owed to receive, it's a credit loss. Okay. Then entity expects to receive discounted at the original effective interest rate. Lifetime expected credit loss. What is this lifetime expected credit loss? The expected credit losses that result from all the possible default event over the expected life of your financial instrument. 12-month expected credit loss. This expected credit loss results from default event within the 12 months of the reporting date. Okay. Now, loss allowance. So we have finished the definitions. Now let's go through loss allowance. Like any asset, when it gets impaired, we have allowance. So for same for financial asset also loss allowance. Loss allowance we have to recognize for financial assets that are debt instrument. Why debt instrument? Why not equity instrument? It is debt instruments that normally gets impaired. Maybe you are not able to pay back, sorry, because you are giving a debt to someone. See, dividends, irrespective of whether you are able to receive or not, whether profit is there, you will get it. Okay? There is no such thing. But when it comes to debt instruments, the other side of the party might not pay you. So it's a loss for you. Okay? They might become bankrupt. Their company might become insolvent. Whatever the case is, there is always a credit risk that they might not pay you. They are your creditors. So that's why for debt instruments, we recognize loss allowance. And we measure them at either amortized cost or fair value through other comprehensive income. That means we either keep it till the maturity, then amortized cost, or we keep it and then sell it. Fair value through OCI. Fair value through profit and loss will not be tested here. So if your credit risk on the financial asset did not increase significantly since you initially recognized your financial asset, then your loss allowance will be equal to the 12-month expected credit losses. So this they will give you in the exam. Okay, 12-month expected credit losses. What is the lifetime expected credit losses? You just have to know what to take and in what situation. If your credit risk increased significantly from the initial recognition, then your loss allowance will be equal to lifetime expected credit losses. Do you understand? So it's about credit risk increasing significantly or not. If not significant, 12 months. If significant, lifetime. That's it. Adjustments to the loss allowance will be credited to the statement of profit and loss. Okay. Like how we adjust provision, under provision, over provision. How we adjust bad dates for receivable. We recognize in profit and loss. Same way. Loss allowance for financial asset also will record in profit and loss. Now, why adjustments? Because your loss allowance can go upwards, downwards. Okay. If it's going downwards, it's credited in profit and loss. If it's going upwards, that means more loss allowance, it will be debited. Now, measuring expected losses. So an entity's estimate of the expected credit loss must be unbiased and probability weighted. That means it has to be based on a probability and it should be unbiased. Discount to present value based on information about past event, current condition, forecast of future economic condition. Receivable. See, receivable is also a financial asset. But the way we measure for receivable is different. It is not a investment in debt also. It's not no investment in equity. It's a financial asset, but it's not investment in equity also, investment in debt also. It is third category of financial asset. And the way we measure is different. That's why receivable is separately given. So the loss allowance should always be measured at an amount equal to lifetime credit loss for trade receivable that do not have a significant financing component. If you can recall my lecture 5, where I've discussed IFRS 15, receivable from long-term customers, from customer with contract. Okay, it's about revenue. Sorry, revenue, not receivable. Revenue from customer with contract. Then this was something which I've given in the last towards the end of my lecture. This part that I've told that loss allowance will be at equal to lifetime credit loss for trade receivable that do not have a significant financing component. There I have explained to you what is the meaning of trade receivable. Having significant financing component and not having significant financing component. In case you did not watch my that lecture, you can go now and watch it. Skip, pause the video, go back, IFRS 15, go towards the end and do watch it and come back to this. Okay, but shortly, let me tell you what does this mean, because I'm sure many of you did not understand what the trade receivable without significant financing component actually meant. It's easy for you to memorize, yes. If we do not have a significant component, loss allowance is lifetime. But what does it mean? And how will you identify whether it is having a financing component or not? It is about your prepayment and payment in accrual. If you are receiving anything has a prepayment, you have received in advance from your customer. It's like you have taken a loan from your customer. So it's a significant financing component which you have to pay back. If you are receiving an advance prepayment, okay, the revenue that you have recognized is more than the amount that you have to receive, then you have to pay back the rest, and it's a prepayment. So that is the meaning of significant financing component. It's like you have taken a loan. That's why financing component. Okay, so that is the meaning of significant financing component. Okay, but if it's a payment and accrual, you are paying late, it is not a significant financing component. Then that trade receivable, you will recognize the loss allowance will be lifetime credit loss. Why? See, something, if you are paying a prepayment, if you are doing a prepayment, risk is less or more? Less, risk is less. Everyone wants prepayment. They want to be paid in advance. But the problem occurs when you're paying late. Payment in accrual is the riskiest area. That's why your loss allowance is equals to lifetime credit loss if you're paying late. If you're paying late means there is no financing component. If you're paying in advance, prepayment, it's a significant financing component. It's like you have taken a loan which you have to pay back. That's why. If you're not still not understanding, don't worry, the full calculation with full explanation is given. You can go back. But I'm sure with this explanation, you should be able to understand. Now, why is lifetime expected credit loss? Okay, so it's about you paying later or earlier. If you're paying later, risk is more. That's why lifetime. Now, derivatives. Derivative is not tested in financial reporting. For FR students, it's not tested, but it is there for SBR. So if FR students want, they can close the video and go to my next video, because after this point onwards it is not relevant for FR students, but it is relevant for SBR students, so they have to watch this till the end. Okay, derivatives is also one kind of financial instrument. We have finished financial asset liability. Now derivatives has to have this following three characteristics to say that it's a derivative. First characteristics, the value of the derivative changes according to interest rate, security price, commodity price, foreign exchange rate, or similar variable. The way derivatives react is based on these things. Okay, either the interest rate goes up, down, security price changes, foreign exchange rate. Okay, next, derivatives require little or no initial investment. Third, it is something to be settled at the future date. If these three criteria are met, it's a derivative. Okay, derivatives which are not part of a hedging arrangement will be classified as measured at fair value through profit and loss. If you are using derivatives for hedging, rules are different. But if you are not using for hedging, fair value through profit and loss. For derivatives, you do not have to worry fair value through OCI or amortize. It is everything fair value through profit and loss only. Okay. Now, coming to hedge accounting. Hedge accounting is an optional accounting treatment. Optional, not compulsory. when your gain and loss on the hedging instrument are recognized in the same performance statement and in the same period as the offsetting gain or loss on the hedged items. There should be an hedged item, there should be a hedging instrument. Remember, if you are making a gain or a loss in the hedged item, there will be an opposite reaction in the hedging instrument. I'm sure you must have heard about options, forward, swap, future. These are hedging instruments. You're taking them to hedge your risk, to manage your foreign exchange risk. All these things are explained in detail in financial management or AFM. But details you do not have to know here in IFRS 9 for SBR and FR. But I'm just telling you what hedging actually does. Hedging actually manages your risk by taking a contract. It could be a future contract, option, swap, forward, money market. There are so many hedging instruments. Okay, why do you take that? To have a gain, of course. So if you're having a gain in the hedging instrument, you're going to have a loss in the hedged item. So the gain and the loss in the hedged item will be offset by the gain and the loss in the hedging instrument. If this relationship is there, then only you can use the hedge accounting. Okay, so in order to follow the hedge accounting rules, following criteria need to be met. First, the hedging relationship consists only of eligible hedging instruments and hedged item. I told you there should be a hedging relationship among the two. For example, if you are hedging using the instrument, it should actually reduce the risk. You should actually be able to manage the risk. If you're not able to manage the risk, there is no hedging relationship. And in the exam, they will often tell you whether hedging relationship is met or not, if hedging is required. At inception of the hedge, when you start the hedge, there should be a formal documentation that says this is the hedged item, this is the amount that you want to hedge, and this is a hedging instrument. For example, what is an hedged item? If it is a commodity price that you want to hedge, let's say in 3 months time your commodity price might rise, so that's why you are entering into a contract to fix the price of the oil at this price, so that even if the future rate goes later up or down, you will still buy the same rate. So that commodity price or foreign exchange is your hedged item. What is a hedging instrument? It is the forward or the future or the option or the swap that you're entering into. That is your hedging instrument. Now do you understand? And there's a documentation saying that you have entered into a contract to buy or sell so and so at this date. That is hedged item. Hedging relationship is effective. Now in the exam they will tell you that also. Hedging effect is ineffective or effective. It's effective, use hedge accounting. Ineffective, can't use hedge accounting. Okay. If the hedged item is a forecast transaction, then the transaction must be highly probable. Remember, you are entering into a hedging transaction only to hedge something that you are forecasting will happen. Okay, and it's highly probable also. For example, you are predicting exchange rate might go down, might be unfavorable. So it is something which is highly probable of happening. If it is highly unlikely probable of happening, then going to that hedging instrument is waste for you. It's a waste of money. Simply. Okay. Now, there are two types of hedge. One is known as fair value hedge. You want to hedge your fair value because fair value keeps changing up and down. You might be gaining sometime, you might be losing sometime. The other one is cash flow hedge. You might be receiving less or more cash. Okay. So in all this instrument that we have just gone through, financial asset, financial liability, debt instrument, equity instrument, there are two things. Either because it has to do with cash, either you're receiving more or less cash or paying less or more cash. That's why you have to hedge cash flow. Next, fair value changes. Fair value can change because finally it's an asset or a liability. So fair value will change. So that fair value is also a risk for you. You want to hedge it. So to hedge. First, let us finish with the fair value hedge. Okay. So at the reporting date, hedging instrument will be remeasured to fair value, like how we remeasure fair value under any standard. Hedging instrument also. The carrying amount of the hedged item will be adjusted for the change in the fair value since the inception of the hedge. So that amount that has been remeasured, you will adjust the carrying amount of the hedged item also when your fair value changes from the date when you have entered to the hedge. So there could be gain or loss, right? Fair value will go up and down. We don't know. So the gain or loss, see the word. The gain or loss. The gain or loss on the hedging instrument and the loss or the gain. It's not gain or loss and gain or loss. No. Gain or loss, loss or gain. That means one party is winning, one party is losing. One party is losing, other party is winning. It also has, it should have this opposite reaction, equally opposite reaction. Plus 50 here, minus 50 there. Minus 50 here, plus 50 there. It's like that. That's how it works. Okay. So if you are having a gain in a hedging instrument, you should have a loss in a hedged item. You can't have gain in both area, nor you can have loss in both. Otherwise, hedging accounting will not work. There is no purpose for you to hedge your risk. You are hedging it so that loss in the hedged item will be offset by the gain in the hedging instrument. That's the whole purpose. Okay. So this will be recorded in profit and loss in most cases. But in other comprehensive income, if your hedged item is an investment in equity, that is measured at fair value through other comprehensive income. Please memorize the last line. Profit and loss, we all know, it's a common scenario. If you remember where it goes in OCI, then it's very easy for you to know. If it does not fall in this, means everything else is profit and loss. Okay, that is investment in equity. If it is measured at fair value through OCI. Other than that, everything else goes to profit and loss. Simple. Now coming to cash flow hedge. So for cash flow hedge, the hedging instrument will be remeasured to fair value at the reporting date. Here also, it will be remeasured to fair value, the hedging instrument. So the gain and the loss is recognized in other comprehensive income. See, if it's fair value change will be recorded in profit and loss. But if it's a cash flow hedge, then the change in fair value will be recorded in the gain or loss due to change in the fair value will be recorded in other comprehensive income. But if the gain or the loss on the hedging instrument since the inception of the hedge is greater than the loss or the gain on the hedged item. Please understand this. If your gain on the hedging is more than the loss on your hedged item, where do you take the excess gain or loss? There is an excess amount. You see, they are not equal. If they are equal, there is no problem. Then that excess gain or loss, both gain or loss, okay, excess amount will be recognized in profit and loss. Okay, only to the amount equal. See, loss of hedged item and gain of hedging instrument, the equal amount 50-50 will be recorded in other comprehensive income, but anything excess beyond that will be recorded in profit and loss. This is for cash flow hedge. Okay, of course you have to do calculations and all which I have done in my IFRS 9 lecture. So these are the exam kit questions. With this I've completed my IFRS 9. So DGY, crypto, Aeron, Artwright, Bismuth, Collide, Hummings. This is for SBR students. Make sure that you do these questions and take your own time to study IFRS 9. IFRS 9 requires more time compared to other standards because there are so many small areas and often questions are also lengthy enough. So make sure that you are able to follow through the questions. But before that, make sure that your concept is sound, because without the strong concept in IFRS 9, you will not be able to do questions. So do not jump to the question straight away unless you do not understand financial asset, until you do not understand financial liability, until you do not understand investment in equity and investment in debt, how they are measured, at amortized, how it will be recorded, at fair value through OCI, how it will be recorded, at fair value through profit and loss, how it will be recorded. Then the hedging instrument, that is cash flow hedge and fair value hedge. Until you do not understand this thing, do not go to a question. Okay. So thank you for watching. I shall see you in the next standard, that is IFRS 10, which is again for the consolidation purpose, which is applicable for your group accounting.